So if you're an investor, you see this one number absolutely everywhere, earnings per share or EPS. It's that headline metric that can literally move markets. But what is it really telling you? Well, today we're going to pull back the curtain and demystify EPS using the official rulebook, AASB 133, to see how this crucial number actually gets built. All right, let's start with a classic investor problem. You've got two companies in front of you. You look at the profit, and company A is making double what company B is making. On the surface, it seems like a total no-brainer, right? But when it comes to investing, the headline number can be seriously deceiving. And here's the twist. See, Company A has a massive 10 million shares out there, while Company B only has 2 million. Now, once you do the math, once you divide that profit by the number of shares, the whole picture flips upside down. Suddenly, each share in Company B represents a claim on $2.50 of profit, compared to just a single dollar for Company A. All of a sudden, that smaller company looks way more profitable on a per-share basis. That is the power of EPS. It is the ultimate equalizer. So here's our game plan for breaking this all down. First, we'll talk about why we even need a standard in the first place. Then, we are going to dissect both parts of that formula, the earnings and the shares. We'll also dive into the very important what-if scenario of diluted EPS. And finally, we'll see why you really need both numbers to make smart investment decisions. First up, why on earth would you dedicate an entire detailed accounting standard to just one number? Well, it all comes down to consistency, and AASB 133 is designed to bring some much-needed order to potential chaos. Just imagine trying to compare two companies. If each one was allowed to calculate EPS its own special way, the comparison would be totally useless, right? That was kind of the reality before AASB 133. This standard creates one single, mandatory rulebook. It makes sure that when you compare the EPS of two different companies, you're actually comparing apples to apples. And here it is, the fundamental formula for basic EPS. Now, it looks pretty simple, but as they say, the devil is in the details. To make sure everything is fair, the standard is super specific about how we define the earnings on top and how we calculate that weighted average number of shares on the bottom. So let's break each piece down. Okay, let's tackle the top half of that fraction first, the earnings. It's not as easy as just grabbing the company's total profit. The calculation has to be done from the perspective of one person and one person only, the ordinary shareholder. And that means we have to make some really important adjustments. Here's how it works. We start with the company's net profit after tax. Simple enough. Then we have to subtract any profit that belongs to what's called non-controlling interests. That's basically the chunk of a subsidiary's profit that belongs to other owners. And finally, and this is key, we subtract any dividends that are owed to preference shareholders. They get paid first, so that money is off the table for ordinary shareholders. Whatever is left over, that's the pool of profit that truly belongs to us. This brings up a really interesting question. What if a company decides, hey, we're not going to pay our preference dividends this year to save some cash? Do we still have to subtract them from the earnings? Well, the answer depends on one very crucial detail. And that detail is whether the preference shares are cumulative or non-cumulative. Now, if they're cumulative, think of it like this. Any unpaid dividends stack up like a debt that has to be paid before ordinary shareholders see a single penny. So for our EPS calculation, we deduct that dividend amount every single year, whether it was paid or not. But if the shares are non-cumulative, a missed dividend is just gone forever. In that case, we only subtract it from earnings in the year it's actually paid out. It's a huge distinction. Okay, we've totally nailed the numerator. Now for the bottom part, the number of shares. You might think, hey, can't we just use the number of shares on the last day of the year and call it a day? Well, no. The standard actually requires a much more accurate approach, one that accounts for all the changes throughout the year. We have to calculate what's called the weighted average number of ordinary shares, or WANOs for short. This method is brilliant because it accounts for the fact that a company might issue new shares or buy back existing ones at any point during the year. It gives us a much more honest picture of the capital base that was actually working to generate that year's profit instead of just a single snapshot in time. And the logic here is actually pretty intuitive. You just take your starting number of shares, and then for any change, like issuing new stock or buying some back, you factor it in, but only for the fraction of the year it was actually in effect. So if shares were issued exactly halfway through the year, they only count as half a share, on average, for that year's calculation. Makes sense, right? Let's just quickly walk through an example. So this company starts with 1 million shares. That number holds steady for 243 days. Then, boom, they issue 200,000 more shares. A little later, they buy back 100,000. By weighting each of these periods by the number of days they were active, we get a much more precise figure. So instead of just using the 1.1 million shares from the end of the year, the correct denominator for our EPS calculation is actually 1,041,918. So now we have our basic EPS. It's great. It tells us the company's performance per share based on what actually happened last year. But investing is all about the future, isn't it? What if things could change? And that brings us to the what if scenario, a super important concept called diluted EPS. You see, a lot of companies have things like employee stock options or convertible bonds or other weird and wonderful instruments that aren't ordinary shares right now, but they could become them in the future. As an investor, you absolutely need to know about this potential flood of new shares. Why? Because of one word: dilution. I want you to think of the company's profit as a big pizza. Basic EPS tells you the size of your slice of that pizza right now. But if all those options and convertible notes get exercised, the pizza doesn't get any bigger, but suddenly it has to be cut into way more slices. That means your individual slice is going to get smaller. That right there is dilution. And this is exactly why AASB 133 requires companies to report diluted EPS. It's a forward-looking, conservative measure. It basically answers the question, what would our EPS look like in a worst-case scenario if all of these potential shares were converted today? It's an absolutely essential red flag for potential risk to your future earnings. Okay, so let's bring it all home. We have these two numbers, basic EPS and diluted EPS. It's not about which one is better. They aren't in competition. They're a team, and they work together to tell a complete story. And get this isn't just some nice-to-have suggestion. The standard is crystal clear. Paragraph 66 of AASB 133 mandates that companies have to show both numbers side by side right on the front page of their main financial statement. That just underscores how vital it is for you, the investor, to have both the now perspective and the what-if perspective. So here's probably the simplest way to think about it. Basic EPS is your scorecard for the past year. It's the rearview mirror telling you what happened. Diluted EPS is your risk assessment for the future. It's like a look through the windshield at potential hazards down the road. And looking at the gap between those two numbers can tell you a whole lot about a company. All right, let's just quickly recap the big ideas. The whole standard exists for one reason: to give us a fair comparison. Always remember that earnings are filtered specifically for you, the ordinary shareholder. The share count is a dynamic average, not just a static number. And most importantly, you need to use basic EPS to see where the company is now and diluted EPS to see the potential risks ahead. You absolutely need both to get the full story. And I'll leave you with this final thought. We've spent all this time learning how to precisely measure the size of your slice of the profit pie, but that's only half the battle, isn't it? The next, and maybe even more important question is, how do you measure the quality of the pizza itself? Something to think about.